So you're looking about 100 to 105 trillion dollars in total debt. And that's
Really?
the single largest item of the budget is the interest expense on the debt. Just so I think we're going to be in this kind of wishy-washy, back and forth, choppy market in gold and silver for probably months to come.
Dan, I want to get you down to talk about everything that's happening right now in the markets. Oil, energy, silver, gold. First, though, let's start off with precious metals. Where are we at right now, and where are we heading from till the end of 2026?
We had a tremendous run up until January 29th of this year. Gold was outperforming stocks, bond, everything basically, as it was rallying up to its high in January 29th. And since then, we've been in a correction, a pullback within a still long-term bull trend. And I don't think the correction or the pullback is complete just yet.
Yeah.
Usually, when you have that parabolic rush into a high, it takes time to kind of unwind that sentiment. Right now, we see that as silver has pulled back, small traders, which is the the retail public, they are currently net long 20.42% of total open interest, which is the largest percentage of open interest that they've been net long in 15 years since September 2011. And remember that 2011 period, gold topped in August, silver topped in August, gold topped in September, and they both went into what we would call a bear market. I don't think we're in a bear market now. I think this is a correction within a bull market, but still there's a little bit still too much bullish sentiment to say confidently that the pullback is over and we're heading higher. So I think we're going to be in this kind of wishy-washy, back and forth, choppy market in gold and silver for probably months to come. And eventually sentiment will get kind of frustrated and say, the bull market's over. And that's when you really want to step in. And I think that next leg within the bull market will take off from there.
Hello, my fellow
What?
silver and gold stackers. We're doing another silver giveaway for the month of May. So this is a fresh month. How you can enter is you like the video, you subscribe to the channel, and you comment your favorite type of silver or your silver price prediction for the end of May. We're giving away 20 ounces of silver this month. Every single month, we're doing a silver giveaway. Last month, someone won 20 ounces of silver. Their silver is being shipped to them. But if you want to enter for this month's silver giveaway contest, like the video, subscribe to the channel, and comment your favorite type of silver or your silver price prediction for the end of May. Good luck, everyone, and we'll see you at the end of May. What is there anything that you have your eye on right now, Steve, that's concerning you? Like, is there anything with yields, bonds, interest
Yeah,
rates? What's
yeah,
concerning you?
exactly. I mean, you hit it right on the nail. Yields and bonds. I mean, the 30-year Treasury is at 5%, and you've got a dividend yield on the S&P of a little over 1%. The lowest since 2000. So you got like four to
Wow.
five more times income on a U.S. Treasury security than you do in the stock market. Now, obviously, you buy stocks because you're looking for capital gains, but they may not come, particularly if the market tops out. So you've got this wide disparity. You don't have a tailwind in stocks based on the yield in bonds, which sometimes you will when bond yields are really low. So we've got that dichotomy working there, and that's definitely problems. I think for the market moving forward. The other thing that I'm keeping my eye on is the mortgage rates. They're now up to 6.5%. They had backed off a little bit, and the housing market just keeps bumbling along. It can't seem to get any sort of momentum or strength, and I think part of that is just because you got a 6.5% mortgage rate, and people psychologically don't want to take that on. But more importantly, people who own mortgages usually have them for like what, 4% or even
hmm
less because of the interest rate environment over the past decade. And so they don't want to put their house on the market, giving up that low interest rate. So that's going to be a problem moving forward too, until that somehow works itself out.
hmm in the United States, you have the $39 trillion in debt. You have interest payments on the debt. The debt servicing is $1 trillion. You have military expenditures that through the roof. If you look back 10, 20, 30 years ago, you couldn't even fathom these numbers of like 39, $40 trillion in debt.
But
Uh,
that's just the federal debt. I mean, then you've
yeah.
got household debt's about what, 17, 18 trillion, corporate debt's about 20, 21 trillion, and then the financial sector debt's about 30 to 31 trillion. So you're looking about 100 to 105 trillion dollars in total debt. And that's
Really?
the single largest item of the budget is the interest expense on the debt, just like you were saying. It's about 15 to 20% of federal tax receipts right now. So it's just unsustainable. And I think that's partly why interest rates keep creeping higher and higher, not only in the United States, but globally, because I think financial markets are recognizing that governments are way over their head. And there's really no way out unless there's some sort of restructuring or defaulting in some capacity on the debt that's outstanding.
How long can they kick the can down the road? And let's say if there is a default, what does that look like?
Yeah. Well, they're going to kick the can down the road as long as psychology, social mood is positive. And it's certainly positive right now. You got
Right.
the market at new highs, even though it's a very thin, narrow list of stocks that are doing that. People feel wealthy when they look at their 401ks. So as long as social mood is positive, they can continue to kick the can down the road. But as soon as mood starts to turn more negative, more dominant, that's really when you're going to have the problem. Now, in terms of bankruptcies, it's tough to see. It's very rare in the United States to do that. So it's probably going to be more of a restructuring where they'll either you took a bond out at say 5%, and the government will tell you, okay, we're only going to pay you 2%, or they're going to extend the maturity. They're going to restructure it somehow. But either way, as an investor, you lose. And so that's probably how it's going to work out. But there's going to be a lot of twists and turns, and we'll see as we move forward.
Let's say in the near future, the US dollar comes to a halt, or there's such a big collapse where the debt is just unsustainable. It is right now, but it comes to a point where the bubble pops. What new system will they push out? Will they just push out a new fiat system? Will they just push out a digital dollar? Like, what happens after the US dollar?
They may not have any choice. It might
Mm.
come down to what investors really view as real money. And if they still view gold as real money, then that might be the only way out. I'm pretty sure they're going to try to digitize it to some degree because it gives them more control over our money, our monetary system. But if mood is very negative, they're going to get a lot of pushback. And that really is where is mood within the process of government trying to get out from all this debt. And if mood starts turning negative and you start going into a bear market, you're going to get a huge pushback from a large segment of society.